We're talking about tax planning for 2021 and beyond. Taxes are near and dear to my heart, or better said, how to save taxes. So let's talk about what some of the new proposals are right now in summer of 2021. First is ordinary income rates being increased, and let's talk about what that means. Right now we have rates from 10% to 37%. We already know in 2026 we're going back to the pre-2018 rates. You can see there starting at 10, going to 39.6. Here's the proposal. The proposal is the 37% rate becomes 39.6. That would be effective January 1st, 2022, if the current bill goes through. Then there's talk about increasing capital gains taxes. There's a 0% capital gain rate, 15%, 20% rate, depending upon your income levels. So what the change would be is if your income is above $1 million, capital gains would be taxed at 39.6 ordinary income rate. Not the 20% rate, but the 39.6. Capital gain rates could double if that passes, and that could even be retroactive to April of 2021. We'll have to see. Also, there's some big changes potentially in estate taxes. There's been talk about no step up in basis. There's been talk about reducing the estate tax exemption. What's currently in the proposal right now is that for all estates that have more than $1 million of gain, the beneficiary or the trust that receives the asset will have to pay taxes on that as if that asset were sold on the date of your death, which would create a lot of hardship to a lot of people. Corporate income taxes. That may go from 21 to 28%, which seems like no big deal until you realize we're going to pay for that because that means higher prices for goods and services. Okay, enough about that. Let's talk about what we actually know you can do, what's current law. And I think it's important to understand there are 3 pools where you can hold your money. There's a tax-free pool, that would be like a Roth IRA. Money comes out of that tax-free. Taxable would be non-retirement account. You hold an asset for more than a year, sell it, you get a special capital gains rate, as I talked about. And tax deferred, well, that's going to be like your IRA, your 401k, your 403b. Money coming out of here is all taxed at ordinary income rates, the highest of rates. So what we'd like to do is get more money up here, tax-free. A couple ways to do that. You can take money out here. That's a Roth contribution, $6,000 or $7,000 if you're 50 and older. You have to have earned income, or your spouse has to have earned income. Tax deferred, well, that would be a Roth conversion, taking money out of here, converting it. You have to pay tax on what you convert, so you need to be sensible about how to do that. But once it's up here, it's tax-free forever for you, your spouse, your kids, whoever ends up spending that money. So when you think about that, you got to understand how tax brackets work. We got this 10% rate to 37. These are our current rates. These are taxable income. Let's just do a little example. 22% bracket if you're married, that's taxable income between $81,000 and about $172,000. Maybe if you're in that bracket, which would be kind of like this here, you partially filled up that bracket, maybe it makes sense to do a Roth conversion to get to the top of that bracket. Thereby you're only paying 22% tax to get money up there. That may or may not be the right answer, but that's how you want to think about how much to convert, is what's your rate today, what's your rate going to be in retirement, and how much is going to make sense for you to convert to get that money into tax-free. Another strategy I want to tell you about is tax loss harvesting. Remember I talked about the taxable account, the capital gains? Well, if you have capital losses, they net against capital gains dollar for dollar. You have an asset, stock, mutual fund, it goes down. You actually want to sell that when it goes down, buy something similar, so when the market goes back up, you receive that recovery. In the meantime, you've created a loss that you can net against capital gains. And if you still have extra losses, you can carry those over to future years. There's charitable strategies, there's all kinds of other things that you can do. But to get more information from that, contact Pure Financial for our tax reduction analysis. No cost, no obligation. Or you can also come in for a free financial assessment. We'd love to chat with you and see what strategies are going to make the most sense for you.